Welcome back to Money Talks Life Listens. My name is Joanne Kaban. I'm a senior wealth advisor, financial planner, and co-founder of Isle Wealth. All right, so let's talk about Canadians moving to the US. I really like Victoria, but maybe I wanted some warmer weather and decided, I'm packing up my family. We're going to California. What are some of the first steps we should take when planning a move?
So if you are planning to permanently move out of Canada, that is one thing. And let's talk about that first. So in Canada, as we talked about in the previous episode, if you are an American citizen or green card holder, no matter where you move, you still have to continue reporting, doing a U.S. tax return. But if you leave Canada and you are a permanent resident, Canadian citizen, a tax resident of Canada, I should say, and you are not a U.S. person, then you can just leave Canada taxes behind. But there is one big stipulation. When you leave, the CRA will tax you on your non-Canadian assets, I would say. That's kind of a broader, that's a little bit more specific. And they will collect the tax. So they call it a departure tax. And how it works is you have, let's say, $100,000 in stock. You have a $50,000 capital gain on those stocks. At the time of leaving, all those stocks will go in your that return. Let's say you leave on October 2025, and then on your 2025 return, you have your date as leaving Canada is the date you left, and at that date, whatever that fair market value is of those stocks, let's say $100,000 with a cost base of $50,000, you have a $50,000 gain, $1,000 gain. Those all need to get reported on the Canadian return.
Is that the same with RRSPs and everything too? Or is it just unregistered money?
Yes, it is not everything. So it is not Canadian property.
Okay.
It is not Canadian businesses with a permanent establishment in Canada. And it is not registered accounts like RSPs and TFSAs. So it isn't everything. For most people, it's mainly stock, I would say, is the kind of the number one that we see. But I would say if you are somebody that holds any sort of significant assets and are thinking of leaving, you would want to probably plan for that a bit. So do a tax estimate, get an idea, work with the professional and get an idea of how much it's going to be. There is an opportunities to, instead of paying that tax at the time, you can give the CRA a security. It is a kind of a process to do so. So if you are planning to do that, it would be, you want to plan that ahead of time and get ahead of it.
So just for clarification, let's just say I have a non-registered investment account and I have like a slew of stocks. If I had a mixture of let's say US stocks and Canadian stocks, and I was going to move, right? I'm going to go to California. If I were to sell my US stocks ahead of time and leave my Canadian stocks, am I avoiding anything?
No, only if it's not actually, when I said, I was like, that's why I said Canadian assets. I was like, not exactly, but it is definitely Canadian property. The idea is the CRA wants a chance to tax.
Right, makes sense.
Right? They don't want to miss their opportunity to tax. You're leaving, you're not doing the returns more. So for things that like Canadian property that they still have some control over when you sell it, even if you live in the US, you still need to report it in Canada. Yeah. Same with businesses. The RRSP comes out. They'll take, if you're not living in Canada, they'll take a withholding on it. They have the ways of taxing that. So it's kind of no stocks, no matter what, will be, held in a non-registered account, will be taxed at departure tax because they can't really, there's no way for them to keep track of that and tax it later.
So this is my creative problem-solving hat on there. There's no way that we can kind of structure this differently. I mean, I'm sure there's always some sort of way, but it's just more of making sure we're doing the right steps. Yeah.
The main thing that we do and see is if you are a U.S. citizen and you are leaving Canada, you're going to have this big tax bill and all of your stocks. You can try to match that capital gain in the United States, and then we can do some foreign tax credits movements. So then what'll end up happening is when you go to the United States, or the stocks will have a higher cost base.
Okay.
You'll have paid tax on it, but then at least you're getting that foreign tax credit in there as well. So there are things you can do, especially if you are a U.S. citizen, that we can do and help. But generally, it's the departure tax is the departure tax. It's not very easy to get rid of. And there's also often just a few extra forms that need to be filled out and everything. You kind of have to list your assets and different things when you're leaving Canada.
Yeah, so it's kind of big accounting and a big ledger of everything you have. Because, Canada, CRA wants their little piece of the pie, too.
Yes, they do.
So we're moving from Canada to the U.S. Can we talk a little bit about Canada Pension Plan and old age security? So if we have these pensions we've paid into all our lives, right? And old age security is based on residency in Canada past the age of 18, right? In order to be eligible to receive the maximum, you kind of have to be living in Canada post 18 for 40 years. Right. And let's just say, you've accumulated some of this, you've contributed to the Canada Pension Plan through working, right? You have to pay contributions through your tax returns, right? And we send it over there, so you build up a little bit of a retirement income based on your working. So I've accumulated these pensions. I'm moving to California. I'm picking on Californians because, I've watched it on TV a lot and I think that's where I'd want to go. And I've been working in Canada my entire life. And so I've been putting money into Canada Pension Plan, right? Yeah. Hoping that that's going to supplement my income in retirement. So I've built up a good little reserve for myself and for when I move. And what's going to happen to me once I get into California now and I'm starting to take that pension plan? How is that taxed for me?
So this, both CPP and Social Security, which and OAS are kind of all bundled in as Social Security in the tax treaty, are only taxable in the country of your tax residency. So if you are someone that are living in Canada, have U.S. citizenship, you are taxed in Social Security, U.S. Social Security in Canada, and it goes same way back. So if you have left Canada, you don't have tax residency in Canada, you're living in the U.S., you will only be taxed for CPP in the U.S.
Yeah, so you're not really going to pay any additional taxes.
I
know a lot of fear for most of my clients is they're going to get dual taxation, right?
Yeah.
But because of the tax treaty we have, it's harmonized. We're not really paying extra tax. I think, is it safe to say that in Canada we pay much higher taxes than the U.S. and most...
Not if you're moving to California.
Yeah. I picked the most expensive state. I'm sorry.
Yes, exactly. So, yes, generally the Canadian taxes are higher. California has pretty high state taxes. And this is slightly off topic, but they don't allow foreign tax credits against their own state taxes. So, yeah, California can definitely make things a little tricky. I will, it is the state that we probably deal with the most. It definitely is. Canadians seem to end up in California the most or have properties in California the most. So, but generally the idea is that you're not supposed to be double taxed. But yeah, I would say Canadians generally pay higher taxes than Canada.
Right. You said something really interesting there, and I don't think it really was off topic, is that there could be different rules per state that you're in, which let's make things even more complex, right? So, again, another plug of talking to a specialist in this area because there's even differences per state that you're moving to, 100%. Right?
Yeah. And, that is something that, you've left, let's say you have left Canada. And so in that case, if you want to just get advice from a U.S. accountant, that's fine because generally there's not that many considerations unless you have Canadian property or rental income in Canada or other income in Canada. But generally, you can pretty easily just use a U.S. accountant. And often if you want to use one that knows their own state rules well, because, it's difficult for cross-border. Again, I know California pretty well, but there's a lot of states out there and I definitely don't know the rules of them all. Yeah, if you're living in the United States, it can often be really helpful to have an accountant from that state.
Makes sense. So let's talk a little bit about RRSPs, so that Registered Retirement Savings Plan and tax-free savings accounts. We talked a little bit about what it looks like moving up from United States to Canada in the last episode, and if you hold those investment accounts, how it's kind of treated in that new country, right? Yeah. So what does it look like moving from Canada to the U.S., holding an RSP and a tax-free savings account when you move down there? Is there any tips or tricks on how, we should deal with this?
I mean, RSPs, you'll get that tax deferral when it comes out of your, when you, withdraw it from the RSP, you'll get if you're no longer a tax resident, or I guess everyone gets the withholdings on their taxation, but I think it'll be a different percentage if you're in the United States. So you'll get the withholdings. The tax-free savings, as we said, is actually taxable in the United States. So, at that point, you might want to consider closing it before you go, or rolling that money into an RSP if you have the room. So things like that, because you will be, the TFSA becomes a lot less tax-free savings once you are getting taxed in the United States.
Right. And that makes sense. And so a lot of the times, we look at when we have clients departing from, Canada to the US, we look at saying, well, maybe we just crystallize that tax-free status at that point, and if it makes sense, we'll withdraw the money and kind of put it in more of a traditional taxable account that they can manage while they're down there, if they're only going for a period of time.
Yeah.
And then again, when they move back to Canada, they'll start gaining more contribution room.
Yes. And in this case, we're assuming all these people are non-U.S. citizens. They're they're of the U.S. in those examples.
Right. So another question I have for you is, I keep talking about moving to California.
You really want to move there?
I know, I really do. And apparently, I better not let my husband and son watch this, because they're going to be starting to think we need to pack our bags. But on a different note, what if I did move down, but I said, I want to keep the door open to potentially coming back to Canada if I don't like it, right? So I decide to rent out my property and just move down to California. What's it going to look like on a rental income standpoint? Yeah. If I still have that property in Canada, maybe no other tax ties other than that, is the IRS going to really penalize me for this?
No, definitely not. So you will get taxed in Canada still on that rental property, and then you can use whatever tax you paid as a foreign tax credit in the United States. Some things to note: there are, again, a lot of filing requirements. And, in Canada, and especially in BC, there are some traps as far as speculation tax, under house using tax, and just there's kind of quite a few rules around rentals now that, you need to be aware of, and it can often depend on location as well. So, again, some traps to look out for. But as far as tax-wise, is if you are living in the United States and you're a non-resident of Canada for tax purposes at this point, and you have a rental property, you are supposed to remit 25% of your gross income monthly to the CRA through a non-resident account. So, so you want to kind of set that all up, again, in motion before you have to start paying it. On our job, we see people paying it a lot late and all these things. But in best case scenario, ideally, you've set this all up beforehand.
Is that all gross income?
No,
or just on the rental income?
It's rental. Yes, it's just rental. And then, the other investment incomes, they do that all. They have their own rules that are done through the brokerages. I thought rental income is the one that you kind of have to take responsibility for. This has been in the news a bit because I guess they tried to penalize the tenant, because that is actually how the rule goes. It's like whoever's paying the rent is supposed to be doing the withholding.
Oh my goodness.
Now, that is not how it works, because how many tenants are setting up a non-resident account and throwing up 25% of their money and then the 75% to the landlord. So, there's kind of two options. Either you get a CRA agent, which is somebody who lives in Canada who collects the money on your behalf and does the withholdings on your behalf. Or, we see quite a few where they're just collecting it and doing it themselves. And then at the end of the year, we request a slip with with the income and the amount that they've withheld to the CRA. So then tax time comes, you have to have what is called an NR4, which is the tax slip that says how much rental income and how much withheld, which should always be 25%, almost always. I'll get to that in a moment. And and you have to do a Canadian tax return where you report that rental income.
I was just about to ask that. So in normal situation, if I don't have real estate and I move to the States, I don't no longer have to do a Canadian tax return, right?
So you don't actually have to. Here's the actual thing. It's actually an election. Good. So, but right now, the CRA has 25% of your gross rental. So, you're charging $2,000 a month. You're paying them $500 a month, but you have expenses of $1,000 a month.
Exactly.
So you have an incentive to report it. That's why they do it this way. You have an incentive to report it on the return. You actually have 2 years from the year end. So for like a December 31st, 2025, you have to do this election return by the end of 2027.
Sure.
You know, don't wait that long. Number one, you should be getting money back. So who wants to wait that long? But it's a very, because it's an election, it has quite a broad due date. But yeah, but you want to do that. There is actually one other option if you don't want to be paying 25% of your every month ahead of time. There's something called an NR6 that needs to be filed before, I believe, the first of the, so if you're want it, the NR6 for 2026, you have to file it before 2026 starts. And it's an estimate of your income and your expenses, and then you pay 25% of the net of that instead.
Which would be ideal in most people's situation.
But you do that, now you have a return that's due, I believe, June 30th.
Okay.
So that return, because it's not an election anymore, you have to do a return because, you've made an estimate. They need to make sure it's correct. And, you have to get in all that paperwork for the NR6 before a certain time. So a lot of the times people just don't bother doing it. They have to do the NR6 every year. So it can just be extra paperwork, and they find it simpler just to do the 25% of the withholdings. I also believe for the NR6 you need to have an agent to do it. So it's not something you can do on your own.
Interesting. I actually did not know this, so this is super fascinating.
Yeah. There's a whole lot to do, and again, most people, at least, it's good to just get a little bit of help and professional advice on if you are a non-resident with income in Canada.
Yeah, fabulous. Thanks so much. So I was mentioning this before about moving to California and leaving the door open. I'm really going with this narrative, okay? Some people just want the best of both worlds, and they want to be a snowbird. So they want to kind of live a little bit of the year in California or somewhere else in the States. I think, New Orleans sounds fun too. And then the rest of the year home in Canada. So I thought it would be fun to start talking a little bit about snowbirds and dual residence.
Yeah. I mean, there's a lot of fun places to live in the United States, I'd say. So, but yes, if you are going in the winter to the United States often, you're going somewhere warm.
I've heard, and I've talked to a lot of clients about the amount of days you can be in the States before you get deemed as a quote-unquote U.S. resident, right? And I believe this is called the U.S. Substantial Presence Test. And what that means when it comes to vacationing in the States or, on that side of things.
I mean, it's so funny, right? Because a lot of these times it's like, all these things that people had no idea. I feel like snowbirds know their days. Yeah. They come to you and they're like, this is what's going on. And you're like, okay, great. Thank you for getting me all that information. So pretty much the idea is that, keep your days under 6 months, which is under 183 days for simplicity. But there is a substantial presence test, which there is a very specific calculation. It's the number of days you spent that year, plus, I believe, don't quote me on this exactly, go look online, but I think it's half of the previous year and a third of the year before that, of the days you spent. So you don't only have to know the days you spent that year, you have to know the days that you spent in the year before and the year before that. Yeah. So
that's probably why they know their stuff, in case they get questioned.
Yeah. And, you do a calculation. If you end up over 183 with that, you can do a form which is called the Closer Connections Exemption Statement. Yeah. Quite a simple form. People do it themselves all the time. It's one that I'd say more of my clients do themselves than I do for them. And as I said, it's pretty simple. They usually know all the answers, and you send that off and you should be good in theory. See what, make sure the IRS agrees that you are still much more closely connected to Canada than you are in the United States. So, make sure to not, get too many things in the United States, I would say, right? Like they look at things like driver's license, where your children live, where your homes are, where, your valuables are, things like that.
Wow. They want to know a lot about you.
Yeah, and that's just, both of the countries will look at that when they're trying to determine tax residency. Those are kind of the main kind of, these main kind of things that they will definitely. Okay.
So it's safe to say that Canadians can spend on average below 183 days, if I'm hearing that correctly.
Yes, as long as they continue having close ties to Canada. So,
Perfect.
You want to have, don't sell your home in Canada and buy a home in the United States and bring your family to the United States. But as long as, you still have your main base in Canada, your family is still there, your job's there, your driver's license there, all those things, then you should be okay.
Perfect. Is it possible to be a tax resident of both Canada and the U.S.?
No, you always have to, all the tax laws only work that you have to choose a tax residency. Now, if you need help, you have, again, those kind of the ties I was talking about, they'll look at like your significant ties.
If you're not sure.
Yeah, and then they can look at secondary ties. We have every once in a while even had someone you can send a form, NR 73, I believe it is, to the CRA, and takes them a really long time to get back to you, but they will determine that you are actually, if you are a tax resident of Canada anymore or not. So if you're trying to leave and you feel like you still have a lot of ties in Canada and you want that, you can do that. But you're always going to have a slightly closer connection to one of the countries, and that's how you determine where your tax residency is.
Okay, so I can't say I want to be a tax resident of the U.S. because I want to pay less taxes. It's not going to work.
Yeah, I mean, you can try anything you want.
Crushing
but
my
RRS
dreams,
is gonna go for
crushing
it.
my dreams.
Okay, the CRA won't like that. They will be like, no, you live here, your kid lives here.
What special filing requirements do snowbirds often miss?
I would probably say that Form 8840, the closer.
So that's the big one. The closer connections, that's the biggest.
Yeah, I think that's kind of the main form that you need to fill out. If you are really a snowbird and you're not going over your time, if you go over your time being there and, have these connections, there's a chance you would have to do filings in the U.S.
Right.
But you will definitely talk to some tax professional, lawyers, and accountants before determining that.
What do you know about Medicare and our healthcare system when it comes to reporting that? Like, is there anything that we should know?
There's definitely things that are helpful in, I would say if you move to Canada, and you can, a lot of people still keep their Medicare.
Right.
Yeah. And, they pay for it off of their Social Security or however, that's how I see them frequently pay it. There might be another way, but I'm not a Medicare expert in any way. But they can, and then they actually are able to go back in the United States and get, sometimes if it's something that's going to take quite a while here in Canada or isn't available for whatever reason, they can go back and do it in the United States. And I think my understanding is that still sometimes there is some cost, but it can be a lot less. And so, a lot of people do consider, I do see a lot of people keeping their Medicare when they move down here.
Interesting.
As well as Medicare at this point is considered eligible medical expense. So, you pay quite a bit for your Medicare each year and it's in US dollars. So you can sometimes get a
nice little tax deduction.
Yeah, look, you get a
credit,
tax credit, for those medical expenses. So, can help.
Perfect. So we've talked a little bit about snowbirding and dual residence. Now we're getting into like a personal fan favorite topic of mine. That's why I do what I do. Retirement and estate planning.
Yes.
Okay, I love this topic. So let's get into it. Let's talk about inheriting money.
That's a good one.
So how is that treated differently in the US versus Canada? I know that's the biggest question a lot of my clients ask me is, especially once they move here, they say, oh, my mom's going to leave me some money. Do I have to pay tax on that?
Yeah.
So how does that work?
It is actually pretty different in the United States and Canada. So it is a good question. In Canada, it's pretty simple. Gifts and inheritance are not reported, not taxable. Estates can have probate on them, that sort of thing. But as far as the money moving, that is not a taxable event. When you pass away, there's taxable events, of course, but the actual inheritance and gifting, it isn't. In the United States, they have a gift tax. And so if you are someone that is gifting, if you are a U.S. person, so a U.S. citizen or a green card holder, you have gifted money to somebody, you may need to report it. Right now in 2025, I believe if you have gifted over $19,000, and the limit changes every year, so you do have to check it, then you have to do a gift tax return. Now, there's no tax necessarily, but you do have to report it. And
what happens if you don't report it? I get asked this all the time.
I don't know the penalty for that, but often the IRS penalties are $10,000. So
I think that's what I saw.
Yeah,
last
yeah,
time.
that one surprised me. They really love that $10,000 punitive. So the amount of times that they actually probably penalize, it's probably less, and people often, come back and argue it. But I've seen them try for even like a mistake on a form and things like that. So they do have these nice penalties there. So yeah, do that gift tax return. And also how it works in the United States is you only have to pay tax if you've hit over the gift tax threshold, which currently in the United States is $13.99 million. So for most people, this isn't going to be a problem.
I'd like to be adopted.
Yeah, I've tried.
By one of those.
Yes. So there has been, with the changes in administrations, it was supposed to go down to, I think maybe 7 million. I can't quite remember the number, something like that. Yeah. And then they've now brought it back in to higher, and now have kept it going to inflation, but it can change at any time as well. So, I know there's some tax planners that are saying, if you want a gift, do it now, because you have all this nice big room that could go away.
Perfect. Yeah. But if it was joint assets?
Yeah. So, and each person has 13.99 currently.
Perfect. So we just need to make sure we're strategically planning our wealth, that we're building it up, that we're keeping in mind that threshold, right?
Yes. If you are, if you're near that threshold. If you're not, you probably don't need to worry about it, but you do have to consider that there might be times when you have to report it and just track how much you're gifting.
Right. So and then is that the same with passing away? So if I pass away, my estate is over that number, and I am leaving that to the next generation. So I'm leaving it to my kids, for example. Are they going to have to pay?
The estate will, yes.
Yeah.
Yeah. It's an estate tax.
Okay. But if it's under, it's fine. It's going to flow through, with other tax things.
There's might be other tax things, but yes.
Flow through.
Yeah.
Okay. Perfect. So what should families keep in mind if they have beneficiaries on both sides of the border, right? I see this quite a bit where I have, there's a son in the States, a daughter here in Canada. They're leaving money in both places.
Yes.
What do we do there?
So in that situation, there would just be extra reporting requirements on both sides. There's on the U.S. reporting, if you are getting money from a trust, or if you get over $100,000 cash from an individual, and a few other spots, you have to fill out something called a 3520 in the U.S.
Okay.
If you're a Canadian tax resident and you get money from a foreign trust, or money or stocks, any amount, you have to fill out a T1142. These are forms in the United States. That's, again, it's going to be that $10,000 penalty. If you don't fill it out in Canada, the max penalty is $2,500 if it isn't filled out, and it's $25 a day. So if it's past 100 days due, you're at the $2,500 threshold. So yeah, so you just you do need to be aware if you are cross-bordering that money, what forms need to be filled out. If you have U.S. situated assets like a property, you don't want to be gifting it to non-U.S. like citizens and residences, because that isn't actually considered in the gift tax for that amount.
Oh, okay.
So all of a sudden you could be paying like 40% tax on that. So we kind of say, don't do that.
Okay. So we talked a little bit about having beneficiaries on both sides of the border. What about executors? I actually had a client come in the other day that named their son as an executor who lives in the States, because, it just makes sense. He's the one who really enjoys doing this type of things. But my client lives here in Canada, right?
Yeah.
What will happen if we name an executor in the States and you pass away in Canada?
So this is not how you want to do it. You always want to try to have the executor in the same place where you are to live in the same place as you are domiciled. Otherwise, the state could be considered U.S. or Canadian, depending on which one you are, which you don't want. That's going to add extra reporting requirements. Ideally, even it would be the best if the state is the executor is in the same province as the state.
Right.
Just makes things simple. The rules are simple. You don't have to start thinking, well, this is the executor, so is this have different rules because they're in Ontario or they're in the United States. So I get it. People have their certain family members. There are other options. Sometimes people can use, other
trust services.
Exactly. And that, and I would definitely say that's something you want to avoid, as having an executor in a different location than where the estate is domiciled.
And I guess the big thing for the executors that are getting paid from the estate, right? Because it's quite common for us to pay it, we up to 5% of whatever the estate is worth here in Canada, right?
Yeah.
When we to executors for doing the work, because it's not easy. I can tell you, I've been an executor, and I do this for a living, and it is tough. I wouldn't wish it upon anybody.
Yes. And then if you're adding cross-border issues to
my
your
gosh.
per child or niece or whoever it is, you're really asking a lot of them.
Exactly. And a lot of people don't know what they're signing up for. So what would happen, from an income standpoint? So let's just say I paid that individual in the States an executor fee.
Yeah.
This is opening up a can of worms, essentially.
It isn't the executor fee isn't the issue. It's it's income. You report it as income,
Okay.
We had
good to know.
a client recently that had this. It's more just opening up a can of worms of where the state is considered its tax home is.
Right. Okay. So now, like, if he was from California, I keep going back there. All of a sudden, it could this individual's estate, even though she died in BC here, it could be domiciled in California.
Yeah, that's a potential risk.
Okay, wow. That's fascinating. So again, talk to a tax professional. Oh my goodness, I'm going to sound like a broken record.
I know.
Alrighty. Are there any other areas on the retirement and estate planning side of things that jump out at you as potential tax risks here?
Because of the tax treaty, it's, the pension income, retirement income is generally pretty simple. There's, you want to look out for like early withdrawal penalties and things like that, as always. But in general, those can be simpler. There can be tax planning things you can consider, if you're going to have a bunch of high amounts of retirement income, you can consider trying to take more investment income when you're before retirement. But as far as cross-border goes, generally pension income is one of the smoother
Perfect.
places.
Great. Raizy, this has been extremely helpful for our listeners. So I thought it might be fun to wrap this up with some quick takeaways for our listeners. Just in closing, if you had one piece of advice for each of these groups of people, what would it be? So let's start with families moving across the border.
Okay, this might not be a shock, but seek professional advice before, as part of your planning to move. It can take a while, 18 months, 12 months. Don't leave it to the last second. Start thinking about what is it you need to do before you move.
Yeah, for sure. And what about retirees considering snowbirding?
Track your days. Just know your days, keep track, and do your calculations. I think they're very good at it, to be honest, you snowbirds.
And lastly, younger professionals who might be moving for work.
Yeah. Figure out your tax residency. You have to know which country has the right to tax you first, if you are not a dual citizen. So yeah, just figure out your tax residency, figure out where your significant ties are.
Yeah, who are those closer connections?
Yep.
For anyone who wants to learn more or get some additional information from you, where can they find you?
On the internet. You can find us on Cameron Izzard Snell. You can just Google our website, LLP, Cameron Izzard Snell LLP, and we actually have a lot of newsletters and things about a lot of these topics we talked about today. If you're a non-resident who has property in Canada, if you're looking at PFIX, if you're looking at moving, we have a lot of newsletters that covers those things. So come check them out.
Thanks so much for joining me today. This has been super insightful. I've learned a lot of new things, even for being in this space as long as I've been. I've got some big takeaway items and things that I'll look out for in case I ever do move to California, even if it's just part-time. So thanks again.
Welcome.